Good afternoon, everyone. It's so great to have you with us today. And I am so excited to be with you all. My name is Sarah Scruggs. I am the Community Engagement Specialist at Harvard University Employees Credit Union. And I'll be doing the first half of our presentation today. Migdalia Gomez, the Community Engagement Manager, will fill in for that second half of the presentation. We will both be on the chat and the questions. So you will hear from us probably in speech, but also in writing from each of us. I'm seeing that a lot of people are joining and some of us have audio, some don't. So if you're having trouble connecting to audio, hopefully you can reach out to us via chat. You're not hearing this, obviously, if you're having trouble connecting to audio, but hopefully you'll be able to reach out to us. Like I said, we're going to talk a little bit more about credit today, but before we get to that, I want to introduce the credit union to you all. Harvard University Employees Credit Union is Harvard's not-for-profit financial institution. We are community focused. All of our members are affiliated with Harvard in some way. Like you all at Boston Children's Hospital, you are eligible to become members of the credit union. Products and services ranging from checking accounts to savings accounts to mortgages and all of those things you're looking for, but with the hometown service of those friendly faces at our branches and in our support center. You can access Harvard University Employees Credit Union from anywhere. You do not have to be in the Boston-Cambridge area to access us. You can do everything online and through the mobile app. You can even become a member online. Don't even need to come into one of our branches to do that. So know that you can access us anywhere, as well as through our mobile banking and online banking. We are glad to be here today and begin this partnership with Boston Children's Hospital, and we are so thankful that all of you have joined us. We're going to talk a little bit more about credit, but before we do that, I want to talk about some logistics for us today because all of you are muted, and that is so hopefully you can do things right now if you need to continue eating, whatever it may be, don't hesitate to do so. Hopefully you can hear us on our end. And we want to make sure that you know where the questions feature is so that you can ask questions during our time together today. The questions feature is either on the right-hand side of your screen or the top navigation. That is where the questions panel is on our screen. So if you could, please let me know where you are joining us from today. Where you are joining us from today so that we can see that you know where the questions panel is. So where are you joining us from today? Okay, I see some people are joining us from Somerville, Washington, D.C. Wow, wonderful. Boston, Alston, Cambridge, Brookline, Boston. Wow, Boston wins out. Brighton, Newton, great. Thank you so much. This just helps me to make sure that you can hear me and that you know where the questions feature is. If any questions come up during our time together, please put them in the questions box and we will be happy to answer those for you. Another thing that I want to share with you all before we jump into our content is that we will be sharing this presentation and recording with you via email. That email will probably go out tomorrow afternoon so that you have access to rewatch anything that may come up, or you may go back and look at a different list or something of that nature that's in our PowerPoint, and you will have access to all of that through your email. So be on the lookout for that email tomorrow. And again, thank you so much for coming. So let's dive right into our topic. We're talking about credit today. How credit works is the first step in this.
Sorry
About that.
No, no worries. Hi, everyone. It's Migdalia. I just wanted to say Wendy is on, so I'm not sure if you want to turn it over to Wendy for a quick intro.
Perfect. Yeah, Wendy. Wendy is joining us from Boston Children's Hospital. So Wendy, I will throw it over to you to give a word of welcome as well.
Thank you very much, ladies. Hi, everyone. I am Wendy Mateo Arias, and I work in the Workforce Development Program for Human Resources. And I am just here to represent our department. And if you have any questions for us, we work along with the benefits team to help promoting these great presentations, just supporting our well-being in the finance area and the health area for our employees. So we hope that you enjoy the presentation. There are more webinars that will be coming. So we hope that if you think they'll be beneficial to you, please register. All of our links are on our Children's Today, the little announcement tab on the left side. And if you have any questions, I will be putting my phone number there so that we can connect on a one-on-one. Thank you, and I hope you enjoy the presentation.
Thanks so much, Wendy. Thank you, Migdalia, for stopping me so she could get a word in. So we are so excited, like Wendy said, to have all of you, but let's get into our topic. Talking about the impact of our credit score. I think a lot of us obviously know what a credit score is, but sometimes we don't realize the impact that it could have on us throughout our financial journey. We think about credit score when it comes to buying a home, right? That's really important when it comes to buying a home. But what is the impact of our credit score on a smaller purchase like a car? What kind of impact can our credit score have? We see the credit scores listed from excellent all the way at the top to a credit score that would actually make you ineligible for a car payment. So let's see, what is the cost of having an excellent credit score? Having an excellent credit score, we get the lowest interest rate, or APR, that you see on this chart, which means that additional cost after 3 years is $0. When you have a great credit score, you are going to possibly get the best offer on your interest rate. That saves us money over time. And you can tell in between that 720 score all the way to a 550, let's say, you would be paying an additional $5,724 over 3 years that someone with a great credit score would not be paying. I know a ton of things that I would much rather do with $5,000 than give it to the bank for holding on to my loan for me. So I highly recommend, if credit score is not something you've thought about much, hopefully this presentation will get you going there. So going in between these two things is really interesting. What is credit? When we think about what are we utilizing when we talk about credit, we're utilizing funds now and purchasing something like education, a car, a home, and paying for it over time. Credit is also credit cards. That is technically a loan to us. What is not credit? Credit is not paying for something using our debit card or income-based funds or checking accounts. Those don't include, those aren't included in our credit score. So what is most important when we're thinking about credit is any money that we've borrowed in the past. That is what we're really thinking of. There are 3 major credit bureaus in the United States: Experian, TransUnion, and Equifax. And each of these bureaus could possibly have different information on us. Why is that? Because not all bureaus will have everything reported to them. Lenders report to the credit bureaus, and it costs them time and money to report to each of the credit bureaus on a transaction. So if you're working with a smaller or mid-sized bank or credit union, they may not report to all of the credit bureaus if you decide to get a small $2,000 personal loan. That may not be information that they send to everyone, but they will check with all 3 of those bureaus if you're getting a large loan, like a mortgage. Each of those will come into play on your credit report. They collect information from lenders, like banks, credit unions, credit card companies, utility companies, possibly, debt collection agencies, courts, as well as any of your past history of borrowing money from a business, right? This information is collected solely on individual users. So this isn't like taxes where if we get married, we do them together. No, these are all based on our social security number that is tied to us as an individual, and it stays that way. And so when you think, oh, my credit score is going to get so much better when I get married to someone who has a great credit score, that's actually not how it works. It is totally reliant on your information only. So what comes up on our credit reports? Our debt comes up, which is any credit card debt, any car loans, education debt, and anything else that we may have debts for. Anytime that you've been sent to collections, it's added to your credit history. Your payment history, so if you've kept up with your payments, have you been paying on time? Have you been paying your amounts in full? All of that is on our credit report. Any open or closed accounts at those financial institutions, so it has our account history. If we've been paying on those and we're in good standing, that's a good thing. We want good account history on there. You can check your credit report anytime you'd like on annualcreditreport.com. This is the only website authorized by federal law to give you your credit report for free once a year. Does that mean you can't get it from other sources? No, you can absolutely go and get it from other sources. This is the one that is authorized by federal law, and therefore you know that this is safe and free to use. During COVID until April of 2022, you can actually access your credit report for free on a weekly basis. Do I think it's necessary to go in every week and check your credit report? Probably not. It changes maybe once every 3 months. So it's good to kind of get in a rhythm, maybe once a quarter of checking in on your credit report. And you can pull all three from all the credit bureaus because they all have different ones possibly. And they all may look the same too. So it is important that you pull all three just to check in on those and to see what history is on your credit report. Because if we don't know that, moving forward, we can't make our credit score better or make those changes that we want to make. So what will a credit report look like? This is a sample credit report from the lender side. So this is obviously from our side as a credit union. This is what the credit union would see if we are trying to make a decision about whether we'd like to lend to someone. So we can see here, there's a few things I'll point out for us together. This is a credit card from Harvard University Employees Credit Union. So this is a credit card that this person has taken out. And we see the credit limit here of $5,500. And the payment history down here, that C means current. So they've been current on their payments for quite some time, a good number of months that they've been current. It looks like they got this credit card, or if we started taking the history on this up to 25 months, November of 2015. So those are current all the way up till now. The only things that we're seeing on here that could possibly be a problem is the high balance. We see the high balance on here of $5,429. And Magdalia is going to speak a little bit more about why it's important to keep that high balance a little bit lower than that credit limit, because lenders would like to see that you're being responsible with the money that you've been lent. And sometimes having a high balance of $5,400 on a credit limit of $5,500 isn't irresponsible. But unfortunately, there's not much context around this high balance. We don't know much about it. Did this high balance happen 3 years ago and they've totally paid it off now? We don't see that. And so you see here the scheduled payment is $127. And right now the current balance is $4,216. So it seems like this high balance has not been paid off in full. So it is important to note that there's not a ton of context that comes to every lender. We're not able to see those exact dates that you've paid off your full credit card and all of those things. That is why it's important that we see here this payment history. We know they're current. They're keeping up with their payments, and that's a good thing. And there's no derogatory or delinquent accounts. That's a very good thing. Another sample, this is from a different type of agency. This is from a collection agency. And it says Comcast, which is odd because Comcast is a cable company or an internet provider, right? So when we think about collection agencies, that means that someone has not paid their Comcast bill and it has now gone into collections. And so we see here that bill was for $310. And unfortunately, it is past due. And it has been past due for about a year now, it looks like. So unfortunately, we've been sent to collections for this. It is seriously past due. That's the payment status. And with this with this individual, what the issue was that they had lived with a few different roommates during this time. They had thought that someone had paid that final cable bill when in reality they had not. And so unfortunately, it showed up in collections on their account. They were easily able to pay this off and were able to talk with the lender about it. But it is important that you get these things taken care of. And so I highly recommend going into your credit report, just seeing what things are necessary for me to take care of. Are there any things that I have think there are errors on my account? So how do you do all of these things? When you think about the credit report, it is important to note that some things will stay on your credit report for quite some time versus other things that will stay for fewer amounts of time. The number one thing that we want on our credit report is open accounts in good standing. The ones that you're paying on time that have that great payment history, if they are still open, that's a great thing. So maybe this is a mortgage for you. Maybe you always pay your mortgage on time. You've had a great history with it. That will still be on your account. And even closed accounts in good standing will be on your account. Like me, I paid off my car loan about 2 years ago now, but that loan is still on my report saying, you know what, she did a great job. She paid on time. Great. But it doesn't say she's still paying now. That's going to be on there for about 10 years. And you see here the lowest one is the credit inquiry. That means that you've applied for credit in some way. So whether it's applying for a credit card or a loan, that will be on your account for about 2 years. And these are all approximate. It is different for each lender, whether they keep it on there for certain amounts of time. So what if you do go into your credit report and you see errors? What are some things that you should do to take care of those? I want to turn our attention to the very middle of this slide. That says contact your lender. Honestly, this is the first thing we should be doing the moment we see an error on our credit report. Contacting the lender that sent it to the credit bureau is probably the best place to start because they can kind of help you with the next steps. Contact the lender and make sure that they have records of all of your payments. This is why it's so important to keep receipts of all of your payments and to make sure that you have all of those things on hand, especially if you're going to dispute an error. If contacting the lender isn't, or maybe the lender says, you know what, actually, I think this was an issue on the credit bureau's side, then you can contact the credit bureau and you have to dispute it in writing. So this is the time when it would need to be via email or send a letter to the consumer, the credit bureau, consumer protection. Normally that's where you would send it. The Bureau then has 30 days to begin the investigation. Unfortunately, they have much longer time to actually resolve the investigation, but they have 30 days to begin it from the time that they receive your writing. And the consumer.ftc.gov does have sample letters if you are needing to dispute an error. Errors happen. Things like this happen. Maybe they typed in a social security number and they were one number off. There's human error. They could do that type of thing and it ends up on your credit report. There could be human error in trying to move over from not making payments to making payments. So it is important to check in on this. And that's why I say check in on your credit report once every quarter, just to make sure that things are looking the way they should. With anything in life, we do probably need to follow up and make sure that the credit bureaus and the lenders are doing what they need to do. So I highly recommend keeping all of this organized so that you're able to dispute any errors that may come up. And now something to talk about as well. What if you see an error on your credit report due to your information being compromised? That could be a much larger issue and problem to take care of. The first thing you need to do is set a fraud alert if you believe that your information could have been taken. A fraud alert notifies businesses to go through additional steps to verify your identity before it issues any credit to you. So when you take out a loan, it will ask for additional identifying information rather than just your social security number. And so know that that will have to happen anytime you apply for additional credit. You can set up a fraud alert for free by contacting the credit bureaus and having them place that alert on your account. The alert lasts for 1 full year. And so this is really the step to take if you believe that you could be a victim of identity fraud. Maybe you're going out of the country for 6 or 7 months and you need to set a fraud alert. All of those things could be done. This is also what you need to think about if you believe you possibly will need credit in sometime in the future. Whereas with a credit freeze, this disables anyone from being able to open accounts in your name. So lenders cannot have access to your credit report. So identity theft can't happen when you set a credit freeze. This is really what you should be doing if you know that an identity theft has occurred. It's time to set that credit freeze. And you have to set a credit freeze on your account by contacting each of the bureaus and setting up a PIN. This PIN number is what you would need to be able to turn off the credit freeze in the future, if that's something you need to do. Or if you'd like to apply for credit, you would have to undo your credit freeze with that PIN number. So it is extremely important that you keep your PIN number if you have set up a credit freeze. A credit freeze lasts until you ask for it to be lifted. So this could last for years. And so it is important to do this if you believe there's been an identity theft on your account. So thinking about some ways to manage your credit score, I believe this is the point where I'm going to pass it over to you, Migdalia, to talk a little bit more about what a credit score is.
Thank you, Sarah. And just a couple quick reminder. I noticed we had some folks that joined a little bit after we started, so I just want to make sure everyone knows you will receive an email with this presentation, and you also are all invited. We're doing a fraud and scams webinar next week, Thursday. I put the link to register in the chat as well. And if there's anything that either myself, Sarah, or Wendy, who's here from Workforce Development, can answer, please use the questions panel. So we are going to jump right into the score now to really, a lot of times when we think about credit, it just goes with it, credit score. And not all of us may be familiar with what it is. Credit scores have changed. So let's go into what goes into a credit score. First, I like to explain what exactly it is. A credit score is the number that lenders utilize to determine how risky you are to lend to. And that's not necessarily saying that you may be a high risk. It's more that lenders want to make sure that they're lending to someone that is able to pay. And really that is in our benefit as consumers. I don't want someone giving me a $500,000 loan if I cannot pay that. I don't want someone giving me a $1,000 loan if I cannot pay that. It's not good for me financially. So it's really beneficial for both ends. Now, how is that credit score? How do they come about? We're going to go into that shortly. But first, there's a couple of things to understand with credit scores. Even though you have 3 separate credit bureaus, Experian, Equifax, and TransUnion, those credit scores are not determined by those bureaus. They're actually 2 separate entities that are outside of those credit bureaus, which are called FICO score and Vantage score, that help determine your credit score. You're going to have a credit score for each of the bureaus and each of the different credit score entities. So for example, I am going to have an Equifax credit score for FICO and an Equifax credit score for Vantage. I'm going to have a different score. It may be similar, it may be in the near close range, but it won't. I've never seen them exactly the same. It might happen, but for the most part, they're usually not the same. So I'll have a TransUnion score with FICO and a TransUnion score with Vantage, and the same for Experian. So you have different credit scores for each of the credit bureaus, and you also have different credit scores between FICO score and Vantage score. Why is this important to know that there are differences? I would say for any of you that are on right now, if you have a credit card app or maybe your primary bank gives you your credit score, just take a look at it right now. Go onto the app, see what your credit score is. You don't have to tell us, this is just for you. And scroll to the bottom to see, usually when they give you the credit score, if you at the part of the fine print, it'll tell you what type of credit score it is, if it's a Vantage score or if it's a FICO score, and it will tell you if it's TransUnion, Equifax, or Experian. it's important to know what score you're looking at, because you might have TransUnion credit score from Vantage of 800, but with a financial institution, you might go to them and they might pull your credit score and they might get a 780, and you might wonder, why is that different? It's because they could be pulling it from a different bureau and a different credit score model. Usually, as I said, they're in the same range, more or less. Anything above the 720s is usually your top tier. Average is about the 650 to 749, 750. And that doesn't mean that if you have a 620 or anything under a 600 that you cannot get credit. It may mean that it will cost you more, meaning that the interest rate will be higher, or you may need to provide additional documentation, proof that you can take on the additional debt. So it is a little bit more challenging, but doesn't mean that it's not an option, that it's not available. So what exactly goes into our credit score? Really, the biggest thing I always like to tell people, think about credit score. Let's take the bureaus out of it. Let's take the credit score agencies out of it. Let's just think about day-to-day life. What if you had to lend money to someone? You know very little about Sarah and I. You know that we work at the credit union. You know that we're talking today about credit, but you really don't know much outside of that about us. Now, if you had to lend to one of the two of us, and you pull a credit report, you can see that Sarah pays her bills on time, and you can see that I'm usually 2 months, 3, 4 months behind, maybe some credit cards I've never paid back and they're in collection. You most likely would want to lend to Sarah over lending to me. Same if it were a family member. If you heard that a family member never pays back, you might decide, okay, I might not lend to them. You might, maybe you're really nice and you might just give them the money, but you may not expect that money back. And that payment history component, same thing with the credit bureaus and what goes into your FICO score. And the Vantage Score model is very similar. I'll show that one shortly, but essentially is, does this borrower repay their debt? And really, it makes sense. You want to lend to someone that's going to pay you back. Payment history, therefore, takes up 35% of your credit score. The second one that's a big one here is the amounts owed. This, Sarah actually showed an example earlier where you saw that there was a credit card, the HUCU credit card, that individual member was really close to the 5,500 credit limit. That was having a negative impact on that individual's credit score because they are close to their credit limit, they're close to their credit capacity, meaning that credit utilization, sort of, I'm throwing all these words that people utilize to talk about credit, but really it just means you're close to that amount that they lend to you. And as a result, if you needed additional credit, you wouldn't be able to utilize it with that card. And it could also mean that you may need to then seek credit elsewhere. It could also mean that you're not able to pay off that debt. I usually get a lot of questions during this time. And as I said, feel free to use the questions panel if you have any. But I usually get a lot of questions here. Well, what if I pay it off in full every month? You may not remember, but when Sarah showed that credit report sample, we weren't able to tell if that individual was paying it off in full every month. All that we could tell was what their minimum payment was and had they paid it off in prior months. So that's why it's best, even if you pay it off in full, try to keep that credit card balance 30% or less of the credit limit. You can keep it at zero. You can charge something and pay it off before that credit card bill is due. You can pay off your credit card weekly. You don't have to wait until that credit card bill is due. I usually recommend, Sarah and I also do budgeting presentations, and we like recommending paying the credit card more often. It helps you for a couple of reasons. It helps you with your budget, keeps us on track with our spending. And also, you don't know when the credit bureau, you don't necessarily, some of you may call, you can try to get that information, but most of us don't really know when our credit card company is reporting our balance. So if we're paying it more frequently, that's going to help us keep that balance lower. So if I have a $1,000 credit limit, I would want to owe $300 or less. That way it does not impact my credit utilization negatively. And that is not only for individual accounts, but also collectively. So if I have multiple accounts, I want to try to keep them 30% overall. And then the other two are important, and they make a difference. But I always say focus on the big ones, because typically if you're focusing on the big ones, you're going to be in a good spot. You have the length of the credit history, that's 15%. And that's why we've heard in the past, don't close a credit card if you've had it open. You're going to lose all that history. I am telling you, it depends. Credit is very personal, money is very personal. For some of us, yes, if we close the oldest account, it's going to have a negative impact. For some of us, it may not, because we could have other accounts. It's really more of an average of the length of credit history. So, for example, if I have two credit cards, I have one credit card that I opened when I was 21, and I have another credit card that I opened 10 years later, and I only have those two credit cards. I have no loans. I have nothing else. I'm going to keep this simple for the example. If I close that card that I opened when I was 21, then I'm going to lose all of that credit history. I'm only going to have the credit card that I opened when I was 31. So I have a much shorter, for this example, let's assume I'm 32. I'm losing all of that credit history because I've only had that other card for a year. Now, if I am 32 but had a credit card that I had open from 21, then I had a card that I opened at 25, I had something for when I was 30, I have more of a credit history. Now, let's say that 31, push it out. Maybe your age is 40, 50, etc. That length of credit history, it does have an impact, but it doesn't always mean that you have to keep your oldest credit cards open. And some reasons you may not want to. Fraud, if you're not utilizing that credit card, that means somebody else could potentially be utilizing it. And unless you're checking your credit report or keeping an eye on all of your accounts, that could put you at risk. Also, just having it open and not utilizing that credit card doesn't mean that it's necessarily impacting your credit history. There are a lot of different apps now through your credit card. There's also a FICO score simulator where you can see what happens if I were to close a credit card. You can also call Green Path Financial Wellness. They're credit counselors. Sarah and I will provide their information shortly so that you have that. And then we have the other two pieces, which also make a big impact: credit mix and new credit. And I do want to emphasize, they make a big impact, but that doesn't mean it's the biggest. They are the smallest. They're at 10% each. Credit mix means the type of credit that you have. You can have credit that is paid off monthly. So that's typically your loans, your installment loans. Those are the ones that we tend to be the best about budgeting for, because we know exactly how much we have to pay every month. It's a mortgage, it's a car loan, it's a student loan repayment. The revolving credit, which is the other type of credit mix, is the one that's harder to predict, because that's based off of life, meaning it could be your credit cards. And sometimes if we go on vacation, we may spend a lot more. Or if something breaks, we may spend a little bit more. Or there may be months that we don't spend as much. So it's harder to predict typically what the revolving credit balance will be. Even though it's good to have both, it doesn't mean that you have to go out and get additional debt just to have a good credit score. That's something that we always want to emphasize. Having a good credit score does not mean you have to have debt, does not mean you have to borrow significantly, doesn't mean you have to pay all this money in interest. And that's important because we don't recommend seeking a credit card if you don't need it. We don't recommend taking out a loan if you don't need it just to build your credit score. There are many other things that you can do. And then there's the new credit. This is called usually a hard inquiry or a soft inquiry. This is when you're applying for credit. Now, why is this going to impact your credit score? I just need to go and get a new credit card, or I need to get a new loan. Well, if you do it once, let's say that it's 2021 is almost over, which is hard to imagine, but let's say that this year I only went out and applied for a new credit card or a new loan, doesn't really matter, once this year. That's not going to have much of an impact on my credit score. So that's 10%. Sometimes it doesn't have that big of an impact, and that's something else to note. Some of these really will fluctuate. It's not exact, like it's going to be exactly 10%. Not always. It does depend. But if I only went out and applied for a credit card once this year or a loan, that's good. That's very minimal impact on my credit score. But what if I applied for a credit card in January, again in February? So far, 10 times this year. That's going to have much more of an impact, because that's a little bit of a red flag. Why is Migdalia seeking credit? Why is she taking on additional debt? is she going to be able to pay off all this debt? And even if it's not that I'm taking on the actual debt, but if I now have credit lines of 10,000, 20,000, and they keep adding up, my credit lines, that's available credit that I have, and that could have a negative impact on my credit score because if I were to go out and max out all those credit cards, I may not be able to pay that back, and I may be at a higher risk to pay back other debt. What if you do need to apply for a new credit card or a mortgage? Well, in those situations, it's best to shop around and look for credit cards or loans during a 2-week period, as long as it's for the same category. So if I'm looking for a mortgage and I'm doing that within a 2-week period, that's going to count as one inquiry. However, if I'm looking for a mortgage, a car loan, and a credit card, 3 different categories, that would count as 3 different categories, and those would be 3 different inquiries. But if I look for 10 different mortgages within a 2-week period, that would really count as one inquiry because it's an understanding that I'm shopping around, I'm looking for the best deal. Before we move on to the next section, I just want to take a quick moment, see if there's anything that I can clarify before moving on to the next part. And feel free to submit questions via the questions panel. Okay, I see someone that wrote, I have a credit card that I opened 10 years ago and I don't use it. Should I close it? I would say it depends. I wouldn't necessarily say to close it or not to close it because, as I mentioned earlier, it really will depend on your credit file. One of the things I will recommend, and we'll put it in the chat. Actually, thank you, Sarah, already put it in the chat, is you can contact GreenPath Financial Wellness. They are accredited credit counselors. It's a free service available to you, and it's free because we pay for it at the credit union. I always like to explain that to folks as, sometimes you hear, how is that free? How are they making money? We're paying for it. They're also a not-for-profit, but they are accredited credit counselors. They can pull up your credit and they can basically review your credit report and let you know based off of your specific situation, would it be good to close that account or should you keep it open? But thank you for asking that. Okay, so I'm going to move on to the next section. But do keep those questions coming, and I'll take another break if any additional ones come up. The Vantage Score is a similar credit score. It's a competitor to FICO, but it's a similar credit score model, meaning that your payment history is really going to be the biggest indicator of your credit score under the Vantage, and same with the FICO. And then the other pieces, the age and the type of credit that you have, that credit utilization or the percent of credit that you're using, that's also going to have an impact. The ones that are not going to have as big of an impact are your available credit and also the credit inquiries. Sarah and I believe in examples. It just makes it easier to put it all together. So here we have some credit scores that we actually pulled. I pulled these many years ago, but the information is still relevant. But essentially here it shows you the credit score of an individual, and here it's 488. But it also shows you 2 different things that I want to point out. It shows you it is a FICO score. So this is not a Vantage, it's not a Vantage, it's a FICO. Also, I pulled this through Experian, so I know that it's an Experian credit score. Had I pulled TransUnion, it could have been different. Had I pulled Equifax, it could have been different. And then the other pieces that is really important when you pull your credit report and get your credit score is that the score factor descriptions. You're always going to have something listed here. It will never say great job or be blank. They're always going to say something. Here, the lower that the score is, the more of the impact that the description will have. In this case, this individual has accounts and collections, their delinquencies, their balances are too high. So here, it's pretty tangible. Okay, I have to take care of these delinquencies. I have to bring down my balances. They're a little too high. That's perfect. That helps. But as we'll see in the next example, as your credit score increases, those aren't going to be as helpful. So here, a different person that I pulled their credit score, they have a score of 656 or had, it was many years ago. I'm sure it's much better now, but they also had negative information or on their collection account or some public record. They haven't had accounts that had been paid. So again, okay, let me take care of those and that will help my score. But in the last example, you will see that this individual has a 748, which is a really good score, but they still have some factors. For example, time since most recent account opening is too short. That does not mean that you need to go out and take additional debt. No, you don't have to do that. Yes, there are other things, too few accounts currently paid as agreed. So yeah, take care of that. But just keep in mind that lack of recent installment information. So that means they haven't taken on a loan. That does not mean you need to go out and take on additional debt. There's no need. If you don't need it, you don't need to do that. Oftentimes especially when we come to these presentations, we want to know, well, what can I do to bring up my credit score? Remember, it's going to be individual. It's going to be your credit score. So what you do may not help someone else. For example, if I pay my credit cards in every month on time, that's 35% of my credit score. That's great. You want to keep that up. But if I continue to do that, my credit score may not improve much because I'm already doing that. I'm already, it may improve for other reasons, but not necessarily because of the payment history, because I already have a great payment history. But if I'm paying my credit cards late every month, well, starting to pay them on time will help me because that's an action that I wasn't taking before. So keep in mind that everyone's credit score is individual. So it might help one person, may not help the other. That's why even though it's listed here as number 3, that individual one-on-one financial counseling is probably going to be the best. There are situations that you may need to access credit and you may not have credit, which is that, famous catch-22. Well, how can I get credit if you don't give me credit? So there are a couple things you can do. Some financial institutions will do a secured credit card. So if I have no credit, or if, I'm trying to improve my credit score and I just, I can't get a good credit card at a good rate, you might want to go with the secured credit card. That is a credit card that is backed by your own money in a financial institution, meaning I could have a $500 credit card, but that $500 would be in a savings account that would be available to my lender should I not pay that $500 credit card. So it's almost like a trade. You put the money in the savings account, they give you a credit card for that amount, and if you don't pay that, then they have access. So it's secured, it's backed by your money. Unsecured credit cards are the ones that we typically think of when we think of credit cards. These are the ones that they give you a credit card for 1,000, 10,000, whatever amount. That doesn't mean that you have to have that in the bank. And then there are special loans. There are debt consolidation loans. We're doing a presentation in a couple of weeks about debt repayment. So if you have any debt, credit card debt, any other student loan debt, any type of debt, we encourage you to come to that presentation, because we'll talk about what are some things you can do to bring down the debt, bring down the interest rate, so that more of your payments actually go towards the repayment of that debt and not just the interest. And then on the next couple of screens, we're going to talk very briefly about choosing a credit card. This is about credit and credit scores, but credit cards are really closely tied, and we just want you to have the information when you're looking to choose a credit card, what to look for. So you'll see here this chart, and I apologize, I have a little bit of a cough, so I apologize for that. But here you can see a couple of different terms that are going to be on any credit card offer that you receive. They have to, by law, provide you these disclosures. May look different, the colors, but the box itself, that cannot change. The columns, that cannot change. You want to make sure you look for the interest rate. It's not the most exciting part. Most of us are looking for the rewards. And yes, rewards are a big part of a credit card. You want to make sure you're getting rewarded, but just keep in mind that for any reward to be beneficial, you need to pay off that balance in full every month. If not, it's not really a reward. I'm paying for that. But you want to make sure you look at what the APR, the annual percentage rate, is for the term of the card. You'll see what the maximum will be. A lot of credit cards, especially store cards, have pretty high interest rates. or online cards nowadays, sometimes 20-something%, close to 30. You definitely want to take a look at that. On the next screen, you'll see a little bit more about fees. So you'll be able to see what the fees are that they will charge you, which may not seem that important when you're looking for a credit card, but usually the fees are, not usually, they are an inconvenience. The fees are things that you don't think about because we're not thinking about losing our card. We're not thinking about paying late. So you want to just know ahead of time what those fees are. I will say if you're ever in a situation that your financial institution charges you a fee, just contact them. Most of the time, especially if they're a good institution, most of the time they'll give you a courtesy waive of those fees. And along with credit cards, sometimes we get too many credit card offers or maybe a loan offer, and we're just, we just don't want to get that. And in the mail, it creates a lot of, it's what we call the junk mail, the original junk mail, and that's a lot of waste for paper. It's a lot of possibly could be compromising your information. You never know if that mail could be intercepted. Someone else can complete an application. So if you wanted to sort of to stop that, one of the things you could do is do the opt out of a pre-screen, meaning that you won't get these communications. And there are a couple of ways you could do it. You can choose to not get it for, I believe it's 5 to 7 years or permanently. Keep in mind, I personally do it for the 5-7 years and then I just go up and put it in again. But keep in mind that if you are looking for a product and you opt out, you're not going to get offers. So that just means that you're going to have to do the work yourself and just be a little bit more proactive. Any financial institution that already has your information, they can still contact you. But let's say that you don't have an account with Bank A and you've opted out, Bank A won't be able to get your information. Your information won't be sold so that other companies can contact you. And I've talked a good amount about Green Path and its free financial counseling. They are accredited credit counseling. They do budget counseling, credit, debt repayment, COVID-19 budget counseling. You do not need to be a member of the credit union. We would love for you to be a member, but you don't need to because we believe as a not-for-profit that as long as our community is doing well financially, that is the best thing for all of us collectively. So we pay for this, so it's available to you for free and anyone in your household. So if you have a family member that is they're having a hard time with credit, we don't want anyone to be stressed out. So just give them this information. When you call, you do have to mention HUECU, the Harvard University Employees Credit Union, but that is just for tracking purposes. They will ask you for your social security number. They will ask you for your date of birth. That is to pull your credit report. We do not get that information. That information is for them to do that, to pull your credit report, but we do not get that information. And they're open 6 days a week, including late hours, a couple of days a week, and on Saturday as well. We also have a blog, and our blog has a good amount of information about credit. So if you're interested, you can just click on the right side, and there are different tags, and you can click on credit and get all of the credit articles or any other topic. We post 3 times a week. We post about everything from taxes to retirement to investing, home buying, elder care, elder financials, fraud. You name it, we're always thinking about it. Or maybe if you have a topic that we haven't talked about, feel free to let us know. We'll gladly put something in there. And I have a couple of things. I know that the disclaimer is here, but I have a couple of things before folks log off. Just a quick reminder that this is for educational purposes. As I said, credit and money is personal, so we want to make sure that you talk to someone about your specific information, and it's just general information. I do want to remind everyone that this is one of many presentations that we will be giving at Children's, and we do have a very quick survey. Sarah's going to put that in the chat. It's very simple. It's huecu.org/survey. If you wouldn't mind completing that and letting us know what we could do better, if you have any other topics that would be of interest. And I'm also going to now, Wendy, I'm not sure if there was anything else you wanted to say before I wrapped us up.
No, thank you for the great presentation, and I hope that everyone who joined us was able to maybe learn a little bit more about the credit score and all the things that we should be thinking about this, as it is an important part of our life when we are thinking about buying things and applying for different loans and stuff like that. So we hope that you enjoy the presentation, and we will have more financial webinars with these lovely ladies here. So we hope that you join as well in the future. Thank you. That was all for